Hi, welcome back. Do you feel a little unsettled? Markets are in chaos. Nobody seems to know where the economy is going. Exchange rates are in free movement all over the place. Now, I want you to hold on to those feelings because the next time somebody asks you, what's the big deal about inflation? I want you to pull up these feelings because this is exactly the consequence of inflation taking center stage. I've been writing about inflation a lot in the last 2 years. In fact, when I first wrote about it in 2021, inflation had first started rearing its ugly head. There were good reasons that people were offering for why it was transitory or transitional. There was coming out of COVID, there was supply chain disruptions, and they said once this goes away, inflation will go away. I conceded those explanations, but I said, even if that is true, policymakers should act as if inflation is real and deal with it early because they could not afford to get it out of the box. Now, of course, that advice went unheeded, and now we're in 2022 and the window is closed for early action. In fact, there are 3 posts I've written in 2022 about inflation. On May 6th of 2022, I put the inflation we were seeing in historical context and talked about why it was so unsettling for so many people. They had never seen something like this during their lifetimes in business or investing. In a follow-up post 2 weeks later, I talked about how inflation can play out in different ways for different companies. Some companies are more exposed to inflation than others, and I talked about why. And a third post, a little while later, I talked about one of the consequences of the return of inflation, which is that risk capital invested in the riskiest parts of every market, seem to have moved to the sidelines in 2022. Now, this post is going to contain very little that's new. So if you've read those posts or watched those sessions, you might get a sense of deja vu, but there's no harm repeating some of the things I said in those posts. So first, let me give you an update on what's happened over the course of the summer to inflation. Inflation, which was high for the first half of the year, has continued to stay high. There's signs that it's leveling off, but it's leveling off at a much higher number. In fact, one of the things I want you to look at in this graph is how different the last decade was from almost every other decade for inflation in the US. During the 2011 through 2020 time period, inflation was both low and stable, a sweet spot, which allowed us to completely forget about inflation. Of course, those days are behind us. Inflation was back in 2021 and even more so in 2022. And you can see that whether you use the CPI, the Producer Price Index, the GDP deflator, inflation is back. And one reason I think we're having trouble is that decade of low and stable inflation has spoiled us. We've forgotten how to deal with inflation in investing and analysis. Now, when inflation first came out, people were slow to adjust expectations. And who can blame them? I mean, you adjust expectations based on your historical experience. And if all you've experienced is low and stable inflation, it takes you a while to say, hey, that's changed. And you can see that when you start to track measures of expected as opposed to actual inflation. The reason I make such a big deal about expected inflation is I think it's not inflation per se that is the problem for investors and business. It's unexpected inflation, inflation that turns out to be higher or lower than expected. And in this graph, or these 2 graphs, I look at measures of expected inflation coming from surveys. One is from the University of Michigan, the other one is from the New York Fed. And they both tell pretty much the same story. Early on, people were slow to adjust. Consumers and investors were slow to adjust to increases in inflation. Expected inflation stayed low. But in 2022, clearly people have woken up. You can see that the Michigan survey is now consumers are projecting inflation to be 5.2% for the next year. And the New York Fed, the survey is also suggesting 6.5%. Clearly, people's expectations have spiked up. Problem with surveys, of course, is that there's really no money behind a survey number. It'd be nice if we had a market set number, a number with dollars behind it, people actually putting money in it, and there is. And it comes from looking at the Treasury market. Before I do that, though, one of the manifestations of how expectations have shifted is to look at the percentage of people who expect inflation to be higher than 2.5% going forward and less than 1.5% going forward. It's a graph going back in time, and you can see again what happened during the last decade. During the last decade, as inflation stayed low and stable, high percentages, 60-70% of people expected inflation to be less than 1.5%. That's clearly changed in 2022. Now, more than 90% of people at the start of September 2022 expect inflation to be greater than 2.5%. Now, of course, as I said, it'd be nice if we had a market set number, and there is one in the Treasury market. The US 10-year T-bond rate is a nominal rate. It's a rate that incorporates expected inflation. It's already in there. The US 10-year TIPS rate is an inflation-protected bond. The difference between those two rates is a measure of expected inflation. Now, in this graph, I've tracked out that expected inflation by comparing. The red line is the T-bond rate, the green line is the 10-year TIPS rate, and the difference is expected inflation. It is true expected inflation has risen over the last year, but you can see the market expectation, at least over a 10-year period, is that inflation is back, but it's going to be about 2.5%. And you're saying, how do we reconcile the 2.5% we're getting in the Treasury market with what we're seeing in the surveys? Remember, the surveys are short-term surveys, the 1-year, 2-year surveys. This is a 10-year rate. In fact, if you took the Treasury market and you looked at the difference between Treasury rate and TIPS rates across the yield curve, you do get a much better sense of what's going on. In fact, there seems to be and you can see this graph if you read my post, that there seems to be a shift in what people are expecting in the short term versus the long term. The expected inflation in the short term in the Treasury market is 4.5%. In the long term, it's closer to 1.5%. For better or worse, the Treasury market investors seem to be expecting inflation to be high in the near term, but subside to the levels it was in the last decade over the long term. Now, as inflation expectations have changed, it has first order effects. The immediate effect is on interest rates. Now, I know we live in an age when everything that happens to interest rates is attributed to the Federal Reserve. It's a little sloppy and lazy. But if you ask people why have interest rates been low for the last decade, the answer you usually get is because the Fed has done it through quantitative easing, through buying bonds in the Treasury market. Now, the Fed has an effect on rates. I'm a realist on that. But the real reason rates have been low for the last decade is in this graph, where I compare the T-bond rate, that's a black line, to the sum of inflation and real growth. Think of that as an intrinsic risk-free rate. It's a very noisy estimate, but you can see that over the last decade, inflation was low and real growth was anemic. Low plus low yields low, and that's what you get with rates. The big reason rates have been low for the last decade is we're a combination of low inflation and low growth. And of course, at the start of 2022, you can see the breakout. Right? During 2021, inflation was high, real growth was high. I'm saying, why did rates stay low? Because of that inertia we talked about. Investors are slow to adjust expectations. So let's look at what's happened to interest rates over the course of 2022. I've graphed out Treasury yields on everything from 3-month to 30-year rates in this graph. And you can see for every maturity, rates are up. But they're up more for the shortest term maturities. We started this year with 3-month T-bills close to zero. They're now at 3.16%. We started the year with, they're now at 3.24%, an increase of 3.16%. And you can see that rates have risen less for the higher end of the curve. The 10-year rate has gone up by a significant amount from 1.63 to 3.69%. The 30-year rate is up. But the biggest changes have been at the short end of the spectrum. And obviously, this has an effect on yield curves. We started this year with a very upward sloping yield curve. On September 23rd, we have a distorted yield curve. It's neither upward sloping nor downward sloping because it depends on which segment you look at. 3-month to 2 years, it's upward sloping. 2 to 10 years, it's downward sloping, and beyond, it's flat. There's something there for everybody. Now, I'm not a great believer that the yield curve is somehow a perfect predictor of what's going to happen to the economy. But there is a message here about the future of the economy that is not a positive one. That's a first order effect. There's also been a clear effect on exchange rates. In this graph, I've looked at how the dollar has performed against 3 major currencies, the euro, the pound, the yen, 2 emerging market currencies, the renminbi and the rupee, and a weighted emerging market, measure of a weighted emerging market performance. And you can see on every single currency, the dollar is up, and it's up strongly. In fact, it's more up against developed market currencies than emerging market currencies. Clearly, that inflation playing out in interest rates is having an effect on exchange rates. Some of this is just interest rate parity coming into play, which is as US interest rates rise relative to interest rates in other countries, the dollar would strengthen. Some of it is a flight to safety, and some of it is God only knows what. Those are the first order effects. There's a second order effect that's much more damaging in my view from inflation, and that is what it does to risk capital. As I described it earlier, risk capital is a capital invested in the riskiest portions of every market. In the fixed income market, it's money invested in high yield. In the public equity market, it's in high growth, money losing companies. In the private equity or the VC market, it's in pre-seed startups, very young companies. In real estate, it's in the most speculative real estate, and even in the collectibles market. If you think of Bitcoin and cryptos as collectibles, it'll be in the most speculative collectibles without a history. The contrast that can be drawn with risk capital is safety capital, which invest in the safest segments of the market. In a healthy market, the two should be in balance. And let's face it, we're coming off a decade of excess in risk capital. There's been too much risk capital chasing too few deals, and it's shown up in a bunch of places, from cryptos rising through the roof, to young money-losing companies being able to continually raise more and more capital at absurdly high valuations. Now, of course, risk capital ebbs and flows over time. And in 2022, we've clearly seen it start to recede. In fact, in this graph, I look at venture capital in the long term. Going back to 2007, you can see the ebbs and flows. In fact, you saw what happened in 2008 during that crisis. And you can see venture capital in the last few quarters leading into 2022. And you can see that in 2021, venture capital continued to do well. But in the first 3 quarters of 2022, we're not fully through the third quarter of 2022. So the first quarter, the second quarter, in July, August, you can see venture capital has dropped off and stayed out of the game. Incidentally, the reason I followed through is, you remember in the first quarter of 2020, when COVID first hit, venture capital left the market, but it came back very quickly. This time it's left the market, not just stayed away, but it's increasingly staying away. There's less and less money being invested in venture capital, and especially in the startup portion of venture capital. The second place you can see risk capital play out is in initial public offerings. If you look at the money invested in startups and young companies, the exit for many of these companies go public. And when risk capital is free and accessible, there'll be lots of public offerings, often big ones. And again, we've come off a decade where IPOs have hit all-time highs. Now that too seems to have passed in 2022. The drop-off has been pretty dramatic, both the numbers and dollar value of IPOs in 2022. We're starting to build a case here. Venture capital is out of the game, IPOs are out of the game. There's one final proxy for risk capital I want to look at. Now, high yield bonds have always been part of the bond market, but until the 1980s, high yield bonds became high yield when they started as investment grade, and then the company went into distress. Starting in the 1980s, you've had companies that are lowly rated be able to issue bonds, high yield bonds, directly to the market. Now, in good times, when risk capital is plentiful, more of that issuance will occur. And when risk capital recedes, less of it will happen. And you can see the graph again. To the left, it's a long term, and you can see what happened in 2001 and 2009 during prior crises. There was less high yield issuance from companies. Tracking that again, in the most recent quarters, you can see the drop off, at least in high yield issuances in 2022. As with IPOs and venture capital, high yield issuance also seems to be retreating from the market in 2022. So collectively, there's evidence that risk capital is leaving the market. A part of you is saying, who really cares? When risk capital leaves the market, it has consequences. The first place it shows up is in the price of risk. In the bond market, it shows up as default spreads. In this graph, I have the default spreads for different ratings classes from AAA all the way down to C and below. And you can see across the board, so the last one is not a zero, it's triple C and below, it's a high yield. And you can see across the board, default spreads are up, but they're up by a lot more for the lower rated bonds than the higher rated bonds. The spread on a AAA rated bond has gone from 0.51 to 0.65%. That's only 0.14%. But on the CCC and below, the spreads have gone from 6.78 to 2. They've almost doubled. Default spreads have widened as risk capital has left the game. That's in the bond market. Now, is there a price of risk in the equity market? Yes, it's called the equity risk premium. It's not as easily visible in the equity market because it's hidden behind stock prices. What I mean by that, if you're an equity investor and you want to earn a higher risk premium, you know how you do it, right? You sell stocks, you push down the price. There's nothing that informs you more about risk premium than what happens to stock prices. As many of you know, I compute an implied equity risk premium at the start of every month. I've been doing it for a long time, and in this picture I show you what that implied equity risk premiums look like in the long term, going back to 1960, and what it's looked like in 2022. If you look at the long term, equity risk premiums go up and down. During crises, they widen. In good times, they narrow. At the start of 2022, the equity risk premium for the S&P 500 was 4.24%. The T-bond rate was 1.51%. Remember that number because collectively, add those two numbers up. Stocks at the start of 2022 were priced to earn about 5.75% as an annual return. During 2022, I've been tracking what's been happening to both the equity risk premium and the T-bond rate. They've both risen. The equity risk premium has gone from 4.24% on January 1st, 2022 to 6.05% on September 23rd of 2022. That's a big increase. Similar to what we saw during the 2020 first quarter, the COVID crisis, 2008 during the banking crisis, in 2001 the dot-com bust. But here's the big difference between what's happening now and then. During crises, risk premium go up. That makes sense. You're scared, you're going to push up the risk premium. But usually the T-bond rate decreases because the same forces that push up risk premiums lead to a flight to safety. With this inflation-driven market, though, as risk premiums have gone from 4.24 to 6.05%, you saw what happened to T-bond rates. They went from 1.51% to 3.69%. In other words, it's a double whammy. The T-bond rate is up, the risk premium is up. You add those two numbers up, the expected return on September 23rd of 2022 is 9.75%. Compare that to the 5.75% on January 1st. The expected return on stocks has increased by 4%. That is larger than the increase you saw in the expected return during any of the crises that I just named. This has been almost an unprecedented increase in expected returns as risk premiums and risk-free rates both go up. Now there's a third order effect. As inflation has taken over the conversation, policymakers have been forced to act. In particular, the Fed is acting, and there seems to be at least a sense of desperation in what they're doing. It's clear that the Fed doesn't like what's happening in inflation. It's not clear that they don't know exactly what to do. But clearly they've decided that the only pathway to breaking the back of inflation is to slow the economy down, perhaps put into a recession. How deep, how long, nobody knows. Now, of course, the Fed's been raising rates, but let's be very clear. Interest rates have not gone up because the Fed has raised rates. The Fed is raising rates because market interest rates are up. If you look at that graph that I have in market interest rates, that preceded the Fed acting. And right now, as I see it, the Fed has two choices. It can do nothing and let inflation play out and hope it's transitory, but there is a very real chance that interest rates and expected inflation could continue to go up. Or it can try to put the economy into recession, painful that it is, and try to break the back. There is no good option left. So if you look at this third order effect, we can start thinking about where we are in terms of value in the market. As you all are clearly aware, looking at your portfolios, it's been a tough summer, a tough year for stocks. The S&P 500 at September 23rd had dropped to 3,693. We're back to where we were at the start of 2021, or even lower. Now the question is the correction over? Should you jump into stocks? It's the one question everybody wants to know the answer to. I will not claim to give you the answer, but I will tell you, I will list out the questions you will need to answer to be able to address, should I be getting into stocks? Is this an overreaction or is there more correction to come? The first is, as I said, the effects of inflation play out in the risk-free rate and the equity risk premium. You've seen the T-bond rate rise. You've seen the equity risk premium go up. The question is, are we done? Is this it? Are we at a steady state in T-bond rates, 3.69%, or is it going to go up even more? Same thing with equity risk premiums. There's also the long-term question. Right now, the market seems to be expected inflation to settle in at where it was in the last decade. But is that true? Even if inflation comes down, is it going to go back to 1.5% to 2%, or are we looking at a higher number? Now, in terms of company performance, there are two big questions. One is, if there is going to be a recession, as many people believe it is, how is it going to play out in earnings? Because right now, and I'll provide evidence, there seems to be little evidence that analysts are bringing in an expected recession into earnings estimates. In fact, they're projecting earnings to grow strongly in 2022 and continue to grow in 2023. They're projecting a growth rate over the next 5 years of close to 6.7% in earnings. And during 2021 and through much of 2022, S&P 500 companies have been returning record amounts in cash flows. A big chunk of those cash flows have been buybacks. In the last 12 months, as the S&P 500 companies have returned close to $1 trillion in cash in the form of buybacks. They're paying out of 91% of their earnings in terms of cash flows. Now the question is, can they sustain that if in fact a recession is coming, uncertainty is going to go up? So the questions are about the risk-free rate, the equity risk premium, long-term inflation, what's going to happen to earnings, and what will play out in cash flows. We focus on earnings and cash flows. As I said, analysts have been projecting, and these are top-down estimates, and the analysts are, the aggregate earnings for the S&P 500. I've tracked what their estimates have been for 2022 and 2023 by month this year. So if you look at those numbers, those are the expected earnings from analysts and the percentage change. Let's take the 2023 number, right? The 2022 number, we're almost 3/4 of the way through 2022. We're pretty close to reaching that number. Let's take the 2023 number. We started the year with analysts expecting earnings to be 244.94 in 2023. This was prior to any talk of recessions. 9 months later, with all this talk of recession, guess where we are? The estimate is pretty close to where it was at the start of the year, 243.46, 0.6% below expectations. So clearly, analysts don't seem to be bringing in any real effect. Now, maybe analysts are right. Maybe the effect of this recession will be so mild you won't even notice it. But we're not seeing it in expected earnings yet. If you look at cash flows again, over the last 20 to 30 years, increasing amounts have been returned in the form of buybacks. And while dividends are pretty sticky, they don't change much, buybacks swing around. During crises, you often see companies cut back on buybacks. So I want to track what's happening to dividends and buybacks in the most recent quarters. As I said, through the first half of the year, dividends were up, buybacks were hitting all-time highs. In the last quarter, this is the second quarter of 2022, companies seem to be having second thoughts, at least, about the buybacks. You're seeing a drop-off in buybacks. And I wouldn't be surprised if you saw another drop back in the third quarter of 2022. Clearly, companies are feeling more wary about the future, and it's starting to show up in the buybacks. Overall, I think concerns are building under the surface, but the numbers don't reflect it yet. So I'm going to tell you my S&P 500 story, and I want to emphasize this is my story, and feel free to change what you don't like. I do think that analysts are underestimating the effect of the recession will have on earnings. In fact, I'm going to knock down their estimates by 15%. Why 15%? Why not? But that is a pretty substantial change. In fact, if you look at my estimates of earnings versus analyst estimates for 2023, I'm estimating significantly lower earnings, and I expect that effect to kind of ripple through and continue. Not just in 2023, but through 2027. So I see much lower earnings than analyst estimates. In the last 12 months, as I said, companies returned 90.5% of their earnings in the form of dividends and buybacks, and you do that when you're feeling pretty good about the future. I think they're starting to feel nervous. I think you're going to start to see that number decline over time to about 80% as companies get more wary about returning cash. I think the bulk of the move in T-bond rates is done. Why? Because I think long-term inflation is, partly because I think the Fed is going to succeed in putting us into a recession. So to be consistent, my expected inflation is going to come down as well. I think it's going to come down to about 3%, not the 1.5% the markets are anticipating. So the long-term T-bond rate I'm going to use is 4%, higher than my expected inflation number. And I do think equity risk premiums are going to settle in about 5%, close to the historical premiums earned by stocks, close to what I've estimated as the implied premium on average between 2008 and 2022. So with those numbers put together, here's what my valuation looks like. I've got the drop in earnings in 2023 and lower earnings than analysts are estimating through 2027. I see less cash being returned over time, which translates into the dividends and buybacks I've estimated. I'm discounting those cash flows back at a required return, which is my T-bond rate, which changes over time, plus my equity risk premium. So that goes up to 9% over time. And the present value that I get for the index is about 35.60. On September 23rd, the index was trading at 36.93. I'm within shouting distance. In fact, I wouldn't even think of this as overvalued. Technically, it is overvalued by about 4.8%. But I would say it's well within my noise term. It looks pretty close to fairly valued with, I think, a pretty, I wouldn't say sober expectation of the future, but a more sober expectation than what analysts and investors seem to be building into prices. So that's where I stand. What does that mean? Well, it basically means I'm not going to go in and do something disruptive to the equity portion of my portfolio. I'm not going to go out and do anything crazy like selling short on the index or going long on or short on the index. But at the moment, if you ask me where I think stocks are, I think stocks are already reflecting a pretty gloomy future in terms of the economy and what they see happening to inflation and interest rates. Now, obviously, you will disagree with me, I'm sure, on many of my judgments. So just to help you out, I've actually looked at what the index would look like with different estimates for the T-bond rate, 2 to 6%, different equity risk premiums, 4 to 6%, and earnings coming in at 15% below estimates, which is what I projected, or maybe you're much more pessimistic than I am, 30% below estimates, or optimistic. I've shaded the combinations that give you values that exceed the 36.93. And you can see that if earnings come in pretty close to estimates, it's pretty close, then I think the 36.93 is very doable. If earnings come in 15% below estimates, you need equity risk premiums to stay below 6%, because they hit 6%, it's going to be really difficult. In fact, as a general rule, if equity risk premiums stay at about 6%, it's going to be really difficult to justify stocks at where they are. So really the question is, how will the fear factor that's been let loose by inflation play out in stocks and equity risk premiums? If you think earnings are going to be 30% or more below estimates, it's very difficult to justify stock price unless you believe risk premiums are going to drop back to 4% and the T-bond rate is going to collapse. So keep that as kind of perspective on where markets could go in the future. So if you're bullish, then it has to be because you don't think the recession is going to have a significant effect on earnings, or maybe you don't think there's going to be a recession. Equity risk premiums are going to quickly converge on historic norms and maybe even get lower, and the markets are then significantly undervalued. On the bearish end, if you think risk premiums are going to stay at 6% or higher, it's very difficult to get to any value close to the index. Now I know that everybody's piling on the Fed now, and I take issue with the Fed not acting sooner. But right now I think they have a choice. They have a choice of letting inflation play out and hope for the best, or initiating policies that create a recession, the hope of breaking inflation back. Now, I know there are some who are saying, why take the certain pain of a recession for the uncertain benefits of reducing inflation? You have a case, but I think I have an even stronger case for saying that if you let inflation get out of control, and there's a chance you could if you don't act, the consequences are going to be long-term and much more damaging to the economy. Inflation is corrosive. It changes, it's just not something it's not just a number, it changes the way we as consumers, as investors, as businesses behave. And it often makes us behave in very dysfunctional ways. If you've never lived in a high inflation economy, you probably don't recognize some of these dysfunctional effects. But I don't think it's worth risking. So I know there's going to be pain from a recession. I know the pain is going to be disproportionately felt by people who are least capable of handling the pain. The people with the least savings, the people at the lowest end of the wage spectrum. But I think the pain of letting inflation come back is even greater for exactly that same group. So we will keep track of this, and I'm sure there will be at least one more post on this towards the end of the year. Thank you very much for listening, and I hope you found this session useful.